Welcome to the Property Profits Real Estate Podcast, the show where real estate investors talk strategy, capital, deals, and growth with your host, Dave Dubeau.
Welcome back, folks. Today, our special guest zooming in from beautiful San Diego, California. And if you're watching this on YouTube, you can see it's a lovely day where John Brackett is zooming in from. He's our guest, and he's been in the real estate space for quite some time. And he and his company, Fidelity Business Partners, are all about commercial real estate. So, John, welcome to the show. Great to have you.
Yeah, I appreciate it. Great to be here and grateful.
So, John, give me a little snapshot as of 2026. What does the portfolio consist of? What do you guys focus on these days?
Yeah. At this point, I would say 90% of our focus is on multifamily assets in what we call core affordable markets, which is a term that I think I created.
So that be in your backyard right there in San Diego? Is that what you're talking about?
Actually, ironically, it is.
Oh, wow, good.
And there's a strategy behind that, but that's really our focus, is buying in markets where the markets are supply constrained and
Well, what's your definition of a core affordable market then? Because I thought I was being facetious there saying San Diego. So
no, it's actually something that we coined internally. It's another word for workforce housing. I think the only difference really is that we're buying in downtown adjacent markets, right? So we're buying in neighborhoods that are within a 3-mile radius of downtown markets.
Okay.
And we just think that those apartment buildings within that radius are just a lot more resilient. The cash flow is more durable. That's been our experience, and we've been able to, I think, prove out that thesis. So we're running with it at this point in multiple markets.
Nice. So how many communities or how many properties are in the portfolio at this particular time?
Right now we have a little over 500 units. Let's see, I think that's roughly I think it's 32 or 33 buildings, maybe somewhere in there. I'm not exactly sure the exact number, but it's somewhere within that range. And they fluctuate. So the buildings, they range anywhere from San Diego, a little bit different market, because a lot of smaller buildings there.
Yeah.
On average, we're buying roughly 14 units plus in San Diego, usually between 12 and 20, because most of the stock there on average is about 10 units. And then in Houston, they get larger. And of course, in San Antonio, they're larger as well, right? 50 units plus 100 units.
Yeah, that makes a lot of sense. Okay, very cool. Well, let's talk a little bit about the San Diego market, because that's interesting. I mean, I've interviewed lots of multifamily guys in Texas. That seems to be the most popular place for a lot of people with multifamily these days. But San Diego's a little bit different. A lot of folks are kind of scared off from California and the California markets. Tell me a little bit about your philosophy and your experience in the properties that you got.
Actually, ironically, I think right now, San Diego has some of the best values I've seen, right? Risk-adjusted returns. I've lived in San Diego for over 30 years.
Yeah.
And so I know the market really well, but over the last 10 years, I've been investing in Texas, right? In Houston, San Antonio, some of the secondary and tertiary markets in between those areas. And, I think when you account for taxes in Texas, right? Because taxes, I mean, you get reassessed effectively every year. And then insurance, depending on the market that you're in, like if you're in Houston, which is a very difficult insurance market. It's a hard insurance market because of weather patterns there. A lot of that creates a lot of volatility in your NOI, right? Your projections. And so over the years, one of the reasons why I left San Diego was I just didn't see the value. But now I do, and so we're fairly aggressively at this point buying in San Diego.
Nice.
I also kind of like LA. I know LA gets kind of a bad rap, but I think because of that, a lot of people have exited Los Angeles, and I think same thing. Some of those core markets within LA I think I just like some of the valuations there relative to the cash flow. And so we're getting ready to, dive into LA as well. I think the risk in California is, I think it's in any market, right? It's being able to manage your assets really well. It's property
Mhm.
management.
Yeah.
And so after a couple of years of just not being able to make third-party management work, we launched our own management company, which was
I was going to ask you about that. Yeah,
yeah,
because
which was
that's going to
about
be a
7 years
challenge.
ago. And I can tell you this, that's made a world of difference. And the confidence I think it gives any operator to be able to go in and execute in markets is really huge, right? And we're just, I've seen this pretty clearly able to provide just a level of value to our investors that I think is really difficult to do with a third-party manager just because
Mm.
the interests are different, right?
Yeah.
I mean, you have competing interests. And, and as many times as I like to think that we've been able to make that work, I think the reality is as an owner operator with a management company exclusively focused on your own assets, I mean the lift that you get from that is just not comparable. So
So, John, how does that work? I mean, I can understand that for your properties in San Diego, but are you self-managing the ones in Texas as well? And if
we
so, do you
are.
have like branch offices of your property management company? How does that side of things work?
Well, let's see. Every property that we own at this point, no, not every one. I mean, the majority of them, I would say 90% of them have on-site managers.
Hmm.
And so whether the
Even
property
the
is a
small
smaller
ones.
asset or a really large one,
Huh.
we have an on-site management team in place. Fortunately, when we um, started buying in Texas, it really, I mean, that's kind of where we cut our teeth, right?
Yeah.
And so it ended up being a blessing in disguise because it forced us to really drill down and learn the management business extremely well.
Hmm.
And I think in addition to that, because we're operating remotely and I got tired of getting ripped off by third-party managers, I think the one thing that became really clear is if we wanted to operate in remote states and do it extremely well, even better than, some of the local competitors, we just had to get really good at accounting. And we had
Hmm.
to put a process in place where we had extraordinarily good reporting, literally down to the dollar. And what it does is it just gives us an advantage, right? Because your accounting and I think your maintenance process, rather, those two go hand in hand. It
Yeah.
just gives you the ability to have a really good idea of how an asset is performing. And more importantly, when an asset's not performing well, you have the information to know why and to make really quick decisions. And, uh, you know, we've learned how to do that over the years, and I think it's turned into an advantage, really.
Oh, huge. Yeah. When you
Yeah.
can have that up to date pulse going on exactly what's happening in the business at any
Yeah.
particular time instead of looking
Yeah.
back 30, 60, 90 days. Yeah, that makes a huge difference for sure.
Yeah. I think that one of it's really ironic, right? Investors, they always want very detailed reports or, consistent reporting. I think we do a good job of that. Sometimes we're told that our reports are too detailed.
Yeah, you
But
get
but
some
what
some
people
guys like
don't
me, they're more the big broad strokes kind of guys, and then you get
Yeah, yeah, yeah. Well, but I think what people don't realize though is that that information is for us internally as well, right?
yeah.
So,
Yeah. Plus these days they could just take that report, put it in good old chat GPT and it'll spit out a good summary for them anyhow. So
yeah, exactly,
yeah,
exactly.
good stuff, John. So we've talked a little bit about what kind of properties you have. Smaller ones in California just makes sense. Larger ones in Texas. You're a little bit more bullish about San Diego and Los Angeles these days. You're seeing more opportunities come up there. What's what's kind of your investment philosophy or what do you do with your properties? Are you turning around, optimizing them, refinancing them in a few years, selling them in a few years? What's your exit strategy?
Yeah, I mean, it really depends, right? It depends on the asset, it depends on the location, it depends on what the strategy is going in. But at the end of the day, what it really comes down to is the business plan that we have um, presented to our investors, right? So it doesn't matter where the asset is. really, if the plan was a 5-year exit, that's what we're shooting for. If the
Okay.
plan was a 7-year exit, that's what we're shooting for. If it was a 3-year exit, then that's really the target, right? Because investors have bought into that specific investment with the idea that they're going to get their money back plus a profit within a certain period of time. And so depending on, what our plan was, that's really what we're always shooting for. Unless, I own the asset myself, or usually with my wife, who was a commercial real estate appraiser for I think about 10 years. And, she's heavily involved in our property management company. She's a very, very
Okay.
smart lady. So unless we own the asset exclusively, normally we're operating to a timeline. Otherwise, if it's just my wife and I, um, I mean, we're buying with the intention of not selling, right? I mean,
Yeah.
that's really our approach. Obviously, at some point, we're always looking to trade up into better quality assets, but when you don't have the constraint of needing to return capital within a specific time period, uh, and if you're really good at managing assets, the longer you can hold them, the better, especially if
Better.
they're very profitable, right? I
Yeah,
mean,
but obviously, yeah,
yeah.
for sure. So a lot of people in multifamily over the last few years have been whacked with, adjustable rate mortgages and increase. You mentioned a few, like the increasing costs of insurance and cost of goods and labor and all these different things. Has that affected you guys at all with any of your properties, and especially in Texas?
It's really interesting. I actually we're going through a study today, but I think we have made, if I'm not mistaken, 8 years times four, 32 consecutive distributions.
Nice.
Yeah. And so the short answer is, were we affected during COVID? Yes. We missed one distribution just because I made the decision, not knowing what was going on, to
Oh no, I
pause.
don't even mean during COVID. I mean the
No, no, I
last
know,
couple of
but
years. Yeah.
my point is that was the only one.
Ah,
Yeah.
that's
And that was an
so.
intentional decision just because didn't know what the heck was
Yeah, it
going
was
on.
scary times back in
Yeah,
those days.
but after we got everything under control, we caught everybody up, and I think there was, if anything, was a really good learning lesson. So do we have challenges? Yes, but I think at this point they're mostly people related, right? Trying to find the best
Yeah.
people that we can to occupy roles where we feel that they're going to be able to make an immediate impact and also become a long-term team member. I don't think that's uncommon though when you're working inside of organizations where they're trying to grow and also grow in multiple markets, right? So I think those are
Yeah.
healthy problems to have. If I had to point out another constraint, I think right now we're doing a pretty good job of though is capital, right? Because real estate, you're not buying a vacuum cleaner. These are expensive assets, and when you want to grow and scale, I think more importantly, buy better quality assets, you need capital.
Mm. So what do
And
you find
so
is working well for you guys for raising capital, finding investors? Who do you look for when it comes to investors?
So really interesting. So I was a commercial banker for 10 years. So I started in banking, and
Mm.
I left banking to start this company in 2008. And most of our initial clients were all my clients in banking, actually like 70% of them. And
Wow.
so I was very fortunate to grow organically through a really good client base that trusted me and literally followed me. And
Yeah.
my first partner, by the way, was my CPA. So
Wow.
we grew
That's saying something.
organically
Yeah.
initially, and then at some point you cap out. And I think we hit that cap probably about 4 years ago, maybe 5 years ago. And so our preferred method of growth, really, when it comes to capital, is um, private capital, right? I hear a lot about family offices, and frankly, I work with only two of them. That it took me probably 6 years to build those relationships where they actually trusted me enough to work with me. So it's a very long sales cycle,
Yeah.
and it's a very different sales cycle. In fact, the estate that we work with, for the first 2 years, I had no idea that they've owned $5 million worth of real estate, and the guy was basically interviewing me for 2 years. It was a 2-year interview process.
Mm.
And then when I found out, how much the guy was worth, he actually was he offered me a job. He offered me the position of a CFO, and I said no because I have my own portfolio, right?
Right.
But I countered and I said, well, why don't we partner on deals? And he accepted, and that was my first real inroad into working with really good family offices. But we only work with two of those, right? Very relationship driven process. The other, everything else is just private equity. It's,
Mm.
systems that we put in place to raise capital. And I think right now we're really dialing that in and we're getting really good at that. And so that's really our preferred method. I think for us, that's just worked really well.
What do you find is working well for you with the marketing for raising capital from individual investors these days?
Yeah, I think that's a really great question. I think that the number one, the best leverage you're going to get is building systems that where you can leverage successes that you already have with your existing network, right? Your existing
Mm.
clients,
Yeah.
because the trust factor is already there. And that's been our experience. The second, I think, will be really putting really good funnels in place that attract people that you want to work with
Mm.
and getting really clear on what that looks like. For me, it's always been C-level executives because I was in commercial banking and that was my
Right.
target market, right? So most of my clients are presidents.
You can speak the
Um,
same lingo.
yeah, we really do.
Yeah.
CEOs, directors, right? Different industries, CPAs, actually, ironically. I
Mhm.
know I hear a lot that, probably not the best clients because very analytical and don't make decisions.
Well, I think if you're reporting like you are,
Yeah.
they probably love it. They'd be
Yeah,
great.
yeah, no, they do.
Yeah.
But that's who I have learned that we work with best as a company. And then of course it kind of spans the gamut from there, right?
Yeah.
But I would say the majority of our clients are either corporate executives or business owners, founders. That's really, our sweet spot.
Yeah. That makes a ton of sense.
Yeah.
Fantastic.
And so we're targeting that market.
Yeah. Yeah. Smart.
Yeah.
So looking forward to the next 12 to 24 months, any big changes in the horizon? Any big plans, goals, aspirations?
Yeah, like I said, I think right now I'm very, very bullish right now on some of the California markets. San Diego's one of them. I'm seeing really, really good value. When I say really good value on a risk-adjusted return basis, right?
Hmm.
And I guarantee if you put 10 people in the room and you ask them what that means, you'll get 10 different answers. But the
Yeah.
way that I define that is really simple. It's we're looking for opportunities where the upside risk is significantly greater than the downside risk, right?
Mm.
And when I can find deals where um, I can create returns that look like that, where they're asymmetric in nature and provide very manageable risk, then you can price in the returns to your investors better, right? Especially the cash returns. So an example, like if I offered someone a 5% yield in San Diego, right, with a total return of 15%, and they might say, well, I don't know, I can get, an 8% yield in Houston, Texas at 15%. Well, and then my response is, I really get that because I know Houston fairly well. But the difference is San Diego has the lowest default rate in over the last 20 years, right? Which is like
Right.
1%, right? I don't know if it's 20, but it's really, really long. It's fairly extensive, but
Yeah.
it's one of the lowest default markets in the country. And so when you start stacking things like that up and you're comparing yields with relatively similar returns, that's where things start getting compelling, right? But I think it maybe it probably takes maybe a different experience level to start evaluating opportunities like that, especially in different markets. But
Right.
not every market is going to offer the same risk reward for investors. And that's why we have three different markets that we focus on, primarily to give investors just different options, right? San Diego, Houston, San Antonio, those are really our three markets. And then some of the tertiary, well, really the secondaries in between.
Hmm.
But that way you can offer out different risk return profiles based on what people are comfortable investing in, right? Usually it's based on where they are in their careers. If you have someone that's younger, very aggressive, and they're making really good money, and they want to be a little bit more aggressive in, how they're looking to invest, usually Houston might be an option, right? Or a
Yeah.
Texas market where the yield's higher, but it just varies. And so that would be an example of what I mean by, risk return profile.
Makes sense.
Yeah.
So, John, as we're wrapping things up here, who are you looking to connect with these days?
Yeah, I think I really appreciate the question. Geez, at this point in my life, I have learned that I just keep things really simple. The more value I can bring to the marketplace, that has always turned out really, really well for me and my team. And so I think, my response to that would be, uh, I think my biggest pleasure at this point is being able to be on shows like this and be able to provide content that hopefully can make someone even just a little bit smarter. I think in addition to that, I'm getting ready to launch a master class that I'm promoting as a courtesy, and that will be on our website here in about a week. I think that'll be a really good starting point for really anyone interested in investing in real estate. And that website is fidelitybps.com. Again, it's fidelityboypaulsam.com, fidelitybps.com. And if you go to our main page, you'll see a masterclass link there. Just click on that, and I think that'll be a great place to start.
Fantastic, John. Well, hey, thanks for being on the show. This has been great.
Yeah, thank you. Pleasure's mine.
All right, everybody. Thanks for tuning in, and we'll see you on the next one.
Thanks for listening to the Property Profits Podcast. If you'd like to be a guest on the show, apply at daveinterviewyou.com.